Interest rates sound like a technical topic for economists and bond traders. In reality, they touch almost everything you do: your mortgage, your credit card, even the value of your investments. In this short update, I will explain the difference between the Fed rate, interest rate, and bond yields, why the 10-year Treasury matters so much, and how the current Fed situation creates both risks and opportunities. Everyone talks about the interest rates, but almost no one actually knows what they mean. Let's start with definitions without putting anyone to sleep. The Fed rate is the short-term interest rate set by the Federal Reserve, the rate at which banks lend to each other overnight. Think of it as the reference rate. That sets the tone for many other short-term borrowing costs in the economy. When we say interest rate in everyday language, we usually mean the rate you actually pay or receive, your mortgage rate, your car loan, your business line of credit, or the rate on your savings account. These are influenced by the Fed rate, but also by competition between banks, your credit risk, and how long you are borrowing it for. Yield is the return you get from owning a bond. For a US Treasury or a corporate bond, the yield is the annualized return you earn if you buy it at today's price and hold it to maturity. Yield moves every day as prices move, even if the Fed rate doesn't change at all. So the Fed sets a key short-term rate, markets translate that into borrowing costs and bond prices, and the yields you see on the screen are the end result of this tug of war. This is the hidden force behind mortgage rates, stock prices, and your cost of living. Now, why is everyone obsessed with the 10-year Treasury yield? Because it's one of the most important anchor points for long-term borrowing in the US, and by extension, globally. For companies, the 10-year is a benchmark for the cost of issuing long-term debt. If the 10-year yield rises, companies usually have to pay more to borrow for the 5, 10, or 30 years, which affects everything from expansion plans to share buybacks. For banks and lenders, the 10-year feeds into mortgage rates and other long-term loans. When the 10-year moves up, the 30-year mortgage rates tend to follow, making housing more expensive to finance, which can cool demand. For consumers, the impact shows up in slower motion, but very clearly. Higher mortgage rates, higher financing costs for big purchases, and sometimes less generous credit conditions. You don't see 10-year Treasury on your loan paperwork, but it is working quietly in the background, setting the tone. Finally, for investors, the 10-year yield is the reference point for which the so-called risk-free rate. It is the baseline you compare everything else to, such as equity, real estate, and private credit. If the risk-free yield is higher, markets reprice what they are willing to pay for risky assets. That's one reason why the stock market can react so strongly to what it looks like a small move in yield. So how does the current Fed environment fit into all this? And why are yields so stubborn? We are in a world where the Fed has already cut rates from a peak, but policy is still restrictive compared to the near-zero era. You might expect long-term yields to fall sharply as the Fed cuts, yet the 10-year Treasury yield has remained relatively stable, even after multiple cuts. That tells us the story is not just about the Fed. It is about what markets believe about inflation growth and risk. There are a few forces likely at work. First, inflation expectations have not fully returned to the low, predictable level we enjoyed for years, especially with the geopolitical tensions and energy risks in the background. Second, term premium. That's the extra yield investors demand for holding longer-term bonds. That might be rising as investors ask for more compensation for uncertainty, fiscal deficits, and geopolitical shocks. Third, growth expectations are not collapsing. Investors still see a reasonable, resilient economy, which can keep long-term yields from falling, even as the Fed nudges short-term rates lower. In other words, the Fed is cutting, but the market is saying, we're not completely convinced the inflation and risk story is over. In the short term, this creates several risks. Markets may be too optimistic or too pessimistic about the path of future cuts. If inflation proves sticky or reaccelerates, expectations for further easing can reverse quickly, pushing yields higher and tightening financial conditions. Geopolitical risks, from conflicts to shipping routes, can feed into inflation via energy and supply chains. If markets starts to price in higher inflation risk, long-term yields like the 10-year can rise or stay elevated, even without the Fed hiking. There is growth risks if the Fed keeps policy tight for longer, while the economy slows more than expected. That could pressure corporate earnings, risks assets, and more vulnerable borrowers, especially those needing to refinance. Looking ahead, the way forward is likely a bumpy normalization, not a straight line back to the old world of near zero rates. We expect interest rates to remain more average by historical standards, with periods of volatility as data, inflation, and geopolitics push markets around. For investors, that means embracing the reality that yields can stay higher than in the last decade, even when the Fed is easing, and building portfolios that can live with that, using high-quality fixed income for real income, and diversification while being selective in equities where business models can handle a world where money finally has a price. To sum it up, the Fed sets the tone, markets set the yield, and those yields shape the real-world interest rates you feel. The 10-year Treasury sits at the center of that system, influencing companies, lenders, and consumers in ways that are easy to underestimate. Our job is to navigate this rate landscape with discipline, using fixed income for income and resilience, and being selective in equities as cost of money finally means something again.